Every Australian who works for a company receives superannuation. This is a savings fund that most often invests in companies through the share market or stock market. But what are shares and stocks? Well, that's what I want to help you understand today. In Australia, companies can be either private or publicly listed. If a company is private, then it's either owned by an individual or maybe a small collection of investors. If you owned part of a private company and you wanted to sell it, just like any other asset you owned, you would need to find a buyer and agree to a price. Also, as the name suggests, private companies can keep their financial situation and business strategy private. They're not required to make them public. Then you have publicly listed companies. They transfer from being private companies by listing themselves on a share market. In Australia, the main share market is the Australian Stock Exchange, the ASX. The company offers to the market parts of the company for a set price. For example, a company might be operating as a private company and they value themselves as being worth $10 million. They decide how many shares or parts of the company they'll offer the market. So say our fictional company, BAM Incorporated, decides to offer 50 million shares. To calculate the price of each share, they divide the total value of the company, $10 million, by the 50 million shares. This gives each share a price of 20 cents. They offer the 50 million shares to the market, and people or other businesses can buy any number of shares. In this initial public offering, that's called an IPO, you will request the number of shares directly from the company. So you fill in a form, send it off to the company. After the IPO is concluded and the shares are trading through the share market, the shares then can only be bought through a broker. Now they charge fees for this service, and I'll talk more about that later. Now, if investors, people and businesses who want to buy shares in the company, collectively want more shares than are on offer in the IPO, the situation arises that the offer is oversubscribed. The company may then advise you that you will not be able to get the full number of shares you wanted, but rather a proportion of them. You then pay the company the total value of shares you'll be receiving, and then you'll be a shareholder in the company. Now, anytime the company makes a profit, you get your proportion of the profit. So say you own 2% of the shares in the company, then you would get 2% of the profit. Now, this share of the profits is called a dividend, and companies will provide them either quarterly, so 4 times a year, half yearly, twice a year, or yearly. That's if they made a profit though. Now, companies will announce the dividend as a dividend per share. For instance, if BAM Incorporated announces a dividend of 5 cents per share and you own 7,500 shares, then your profit payment from the company will be 5 cents multiplied by 7,500, which gives you $375. But be aware, the company first has to make a profit and then decide to share it among the shareholders. The company management may decide that it'd be better for the company to keep the profit and invest it in growing the company or investing in other companies so that future profits can even be greater. Or a company may not yet be in a position to make a profit. Now, investing in a company that isn't currently making a profit can be a highly risky proposition. You're speculating that future returns will cover the period of time when there was no profit. I like to use the analogy of working for a business and being told that they won't pay you just yet, but you'll get paid sometime in the future and it will cover you for when you weren't being paid. Or there's a potential for a large bonus when you decide to leave the job. If you were in a position where it didn't worry you if you got paid or not, then this might be a good proposition. But if you need to be paid regularly, then you'd pass on this job opportunity. So let's imagine you've decided to go with shares that pay a dividend. Now, to the Australian Taxation Office, this is classed as income and gets added to your total income for the year. So potentially, you may need to put some money aside from the dividend payment to pay extra tax. Now, it all depends on your current income level and the type of shares you buy. I'll go into detail about the tax implications of owning shares in another video. It's always good to seek financial advice from someone who is qualified to give it to you. Now, how does a public company work? Well, the company is run by a CEO, the Chief Executive Officer, but they are overseen by a board of directors. Now, these directors represent all the owners, and there are regulations regarding their independence. So the board doesn't make decisions to favour some owners over others. Now, the board has responsibility to oversee the operations of the company and to ensure it's operating in the best interests of the owners or shareholders. Now, once a year, all the shareholders have the opportunity to gather for a meeting. Now, this meeting's with the board, and usually key employees of the company will also attend. The CEO, the Chief Executive Officer, the CFO, the Chief Financial Officer, the Company Secretary, and potentially others who may be able to provide insight into the business. Now, this meeting is called the AGM, which is an acronym for Annual General Meeting. The company uses the meeting to discuss how they performed in the past year and how they think they might perform in the future. There are also ideas presented at the meeting, and these are called resolutions, which owners can vote on. Shareholders may also have the opportunity of voting in or out directors of the board. Now, this might happen if a board member resigns or shareholders are concerned and they're taking action because they don't believe the board member or members has done a good enough job. Okay, let's look at 3 key points from this video. The first is that shares are partial ownership in a company which you can buy or sell on an exchange. The second point is that profit from the company can be paid to shareholders as dividends. Your portion of ownership in the company determines your proportion of the distributed profit. Now, thirdly, the company board is a group of people who make high-level decisions in the running of the company. Shareholders can determine the membership of the board through voting at the AGM. Well, I hope this has helped you gain a great overview of what shares and stocks are, and I invite you to comment below with any other questions you have. Until next time, keep being a better Aussie man.